All right, welcome back, everybody. It's only Tuesday, and it already feels like there's been a lot of news this week. So I narrowed it down to just three main topics I want to talk about today. One of them is, I'm sure you've already seen this. I tweeted it out as well if you follow me on Twitter, but Senator Bernie Sanders is proposing to cancel $1.6 trillion of student loan debt in the U.S. The people that he has targeted to pay for this student loan debt is what he calls Wall Street. So I'm going to go over this at the end, share my thoughts with it of why I do not think that this is a good idea at all. The next thing, the main story that I wanted to cover actually was I did like a week ago or so, I did a video on Costco, and I went into it as just a whole approach looking into the company. I wanted to do something similar of Boeing, give you an update on where this company stands. It's been through a lot. There's a lot of news going on with Boeing. People are confused of whether it's a good investment right now. So I'm going to be going over that. This story from the Seattle Times is probably the most in-depth one I've seen on this whole fiasco that it's been through. So I'll go and summarize this story as well as share a lot more data on Boeing. And then the news that happened today that I'm sure you guys have, most of you have heard if you're dividend investors, is a healthcare company called Abbvie. It just announced that it's going to be buying Allergan. So it's buying another company. It's a huge acquisition. And Abbvie has not been doing well. So that's what I'm going to start with, talking about that. It's the one I've had the most questions about, actually. Before I jump into any of that, I just want to mention real quick, for 2 seconds, we are on the Apple Podcast Store. So the Joseph Carlson Show, just search that. It'll show up in the Apple Podcasts. Thank you for everybody that's rating it. I appreciate that. As well as people on Android. Haven't forgot about you. So we're on SoundCloud. We're on Spotify. Those are the two Android platforms that I'm on right now. I'm trying to get on Google Podcasts, but I've learned one thing, that you actually can't just submit your podcast to Google Podcast. You have to wait for Google Podcasts to go and scrape it on the web with their bots or something like that. So I'm going to figure out that and try to tweak some things so that it does it quicker, but I don't really have direct control over that. But for iOS users, there's an audio only version. For Android users as well. So now I'm not eating up your guys' data. I don't want you to pay phone companies more. So now you have an audio version if you're traveling. Anyway, let's go ahead and jump into these stories.
Abbvie's acquiring the Botox maker Allergan. The price tag, it's a $63 billion deal worth about $188.24 a share, at least at the open, in cash and in Abbvie stock. That's a 45% premium to Allergan's closing price yesterday. Yeah, this is one that did not leak, and so they're able to say not the last month or the last week, but yesterday, a 45% premium, Sarah. That is very significant.
So as he says in this video, Abbvie is buying Allergan for $188 a share, a premium of 45%. And like we've seen this play out many times, the bigger company that's doing the purchasing always is the one that seems to go down in value. The one that's being purchased at the premium always seems to go up. That's just like the typical reaction. And in most cases, I think it's warranted. If you actually look at the stock here, let's go over and check this out. So Abbvie, I can go to a 5-day view here of their stock, and it's pretty flat for 4 days until you see the announcement, and it drops down 16% in 1 day. That's how shareholders of Abbvie are reacting to this news. Now, if we look at the other side of this, Allergan, again, the share price is flat for the 4 days, and then all of a sudden it goes up, but it goes up 26.4%. Now, neither of these, I think, have been doing all that well over a longer time period. If I go to the max view here, you can see Allergan has been going down for about the past 5 years, about 50 or 60%. I think they've been on the market for a while. I believe it was Pfizer that was planning on purchasing them and backed out. But either way, I haven't been following Allergan all that much, so I don't know too much about this company. Abbvie is the same boat where they haven't been doing that well for the past while. Now, pretty much with Abbvie, the big thing that people find out about this company, or the thing that people know about them the most, is that they're a big dividend payer. Like if I go in and look at this, they pay a 5.46% dividend yield. So it's a really high yield. If we go to their graph here, let's look at their dividend history. We can go to all here. So look at these dividend increases. From 2018, they were paying 71 cents a share. Then in 2019, they bumped that up to 96 cents. So like a 30% increase there. Then from 96 cents a share to $1.07. This is incredibly fast dividend growth. If I go over to this dividend growth tab here, yeah, 1 year, 38%. The 3-year growth has averaged 21%. Crazy fast dividend growth. And so far, that's been the only redeeming quality of this company. It has not been performing well over the past 5 years because, well, there's a big concern. So Abbvie, if we look at the profile, they have one drug that is amazing, Humira. It's the best-selling drug in the world. And in 2018, this drug sold $20 billion worth. Just one drug. Now, they know on the calendar, I believe it's 2023, that their exclusivity of this drug no longer exists. Now, other people can make it. But since they have all the market share and they have the name with it and all that stuff lined up, it's not like they're going to go from selling 20 billion of it to zero in 2023, but it will pretty rapidly decline their sales on it. They will no longer be the exclusive seller of Humira. So that is the negative story behind this company. I believe that's what's driving this downward trend in their company. And so they're looking at this and they know that this is just going to continue happening. They're marching towards that date. They have strong sales right now, but they don't really have much of a future. So what do they do in that situation? They buy something. That's what a lot of companies do. They expand their reach. They expand their market. They might be able to put some of their money from this Humira drug into some of the things that Allergan's working on. Maybe Allergan can use some of that money when they're together now. Allergan can use some of that money to help develop some of their things and become more profitable. I don't think it's a great option, but it's not a terrible option either. I was asked on Twitter what would happen on the potential that Abbvie decides to slash it, cut its dividend. If they cut their dividend, if they just completely get rid of their dividend, I'm completely selling them. Won't even be a decision for me. Won't even be a hard decision for me. I'll just sell them. Don't have any problem doing that. Now, if they reduce it like 20 or 30%, if it yields still above 3% or something like that, I would likely keep it. I think that they might still be able to have future prospects. I'll have to reassess them. It would be the same type of thing as if I'm kind of buying them new, looking at it as a new company, if I would still buy it if it was a new company. But that would take reassessment. If they get rid of the dividend completely, I don't care how much of a loss it's at, I'm selling it. And they know that. This is a dividend-paying company that a ton of the investors that own this company own it because they have a fast-growing dividend. They know that if they get rid of that, it is going to wipe out a lot of their market share. So that decision is going to be taken into consideration when Abbvie looks at whether they're going to keep their dividend or not. I'm hoping that they'll continue to keep the dividend, but I don't know. I'm not in control of that, so we'll see what happens with that. Now, moving on from that, I want to talk about Boeing. This company has been through a lot in the past couple months, and I want to rewind a little bit further back and just highlight some of where this company has been in just the past couple years. Let's go ahead and I'll show you one clip here.
Becky, these are very strong earnings for Boeing for the fourth quarter and for the full year, and the guidance is also going to be much stronger than many were anticipating. Let's do the fourth quarter numbers. First of all, beating the street by a wide margin, earning $5.48 for the fourth quarter, 90 cents better than the estimate out there right now. Revenue coming in better than expected, $28.3 billion for a point of reference.
This was the story of Boeing for a couple years. Just beating estimates, crushing estimates, 90 cents above what their earnings is per share, what their estimated earnings was. This was the 2018 fourth quarter report. And if I go and I look at a graph here, this is the Boeing chart from 2017 to 2018. Boeing went up pretty much 100%, doubled its entire market cap of its company during that time. Then from 2018 to 2019, it went a little flat until those earning reports came out and it shot up even more. And then at the peak, we have around March 10th, we have this news.
Our breaking news, an Ethiopian Airlines flight has crashed shortly after takeoff from Addis Ababa, killing all 157 passengers and crew thought to be on board. The airline told state media there were people of more than 30 nationalities among the dead. Now,
March 10th of this year, when we heard that the second plane, the Boeing 737 MAX, went down, Ethiopian Airlines, killed a lot more people. And it caused a lot more confusion. It took time for the U.S. and the FAA to actually ground the planes. Other countries did it first. All around, it was a pretty bad look for Boeing. Now, the stock, because of that, if I go into the year to date here, it went down. I mean, it's down about 16%, which I still think is pretty remarkable considering the circumstances in which this went down. It's pretty crazy with the amount of hundreds of people dead and the problems that happened. But obviously there's something to this stock when it only falls that much when this type of thing happens. Now, what I wanted to do was go over this article. And this is one, I'll go ahead and I'll link it in the description of the video. But this is a Seattle Times article, and I think that they've done by far the best coverage of this story, of the Boeing 737 MAX. It's the most in-depth. This is obviously very long. It's like 10 or 15 pages long. I went through and I read through the whole thing when I had some free time. But I'm going to go through and I highlighted some portions that I think summarize some of the background of how this got to this point. Because we know the technicalities of what happened, the MCAS systems, how it malfunctioned, what it was supposed to solve. But what that leaves out is how this company got to a point where this got released. So I'm going to go through and just summarize a little bit of this article, stuff that I don't think has been talked about a whole lot. It tells this whole story. It says, in the wake of the two crashes, despite an outcry from the public and from some pilots, airline industry officials, Boeing has defended the process behind its MCAS decisions and refused to accept the blame. So if you remember back, I did a video like 2-3 weeks ago about how Dennis Muilenburg, he had this press conference and they asked him, how could how has this followed your design protocols? And he said it really did. And this story highlights how that happened, how it followed the design protocols but still failed. So it's interesting. He was right that it really did follow the design protocols, but I think this was a situation where to get all these regulations, they have to go through so much red tape. It's incredible the amount of red tape they have to go through. But what happens with all of that is sometimes I think common sense is kind of thrown out the window in a couple different particular situations, and instead just looking at these rules are the only thing that people focus on. And I think that's what happened in this scenario. It says, the grounding of the MAX has entered the 15th week. Safety officials around the world are scrutinizing the changes to the MCAS that Boeing has proposed to ensure that such accidents won't happen again. This goes back to the wind tunnel and simulator tests. It says, though Boeing was locked into a plan to revamp its popular 737 model, the Seattle wind tunnel tests in 2012 revealed a problem. During flight tests to certify an airplane, pilots must safely fly an extreme maneuver, a banked spiral called a wind-up turn that brings a plane through a stall. While passengers would likely never experience such a maneuver on normal commercial flights, it could occur if pilots for some reason needed to execute a steep banking turn. Engineers determined that on the MAX, the force the pilots feel in the control column as they execute the maneuver would not smoothly and continuously increase. Pilots who pull back forcefully on the column, it's sometimes called the stick, that's the stick they pull back on, might suddenly feel a slackening of resistance. An FAA rule requires that the plane handles with smoothly changing stick forces. While the problem was narrow in scope, it proved difficult to cope with. The engineers first tried tweaking the plane's aerodynamic shapes. According to the two workers familiar with testing, they placed vortex generators, small metal vanes on the wings, to help modify the flow of air, trying them in different locations in different quantities and in different angles. They also explored altering the shape of the wing. Now, this goes on and explains how the solutions that they preferred when they have problems with the aerodynamics of the plane are not software solutions. They try to do physical solutions to the plane to change the aerodynamics so it flies the way it should without them implementing any kind of software fixes. But it just got to a point where they couldn't fix this through normal aerodynamics. There's no amount of changes that they can make to the wings and to the plane to make up for this. And so what they did is they pretty much just decided to go with the software fix. It says, as the pilot pulled on the control column, this uncommanded movement in the background would counter the jet's tendency to pitch up and smooth out the fill of the column throughout the maneuver. An engineer recalled Craig testing MCAS for the first time in a simulator. Yeah, this is great, Craig gushed after seeing how MCAS responded, according to the engineer. This original version of MCAS, according to two people familiar with the details, was activated only if two distinct sensor indicators such an extreme maneuver: a high angle of attack and high G-force. So originally, the MCAS had two different things that had to happen. Had to have the angle of attack and a high G-force. Now, later on, that G-force sensor no longer became a requirement. If I go further down, it says, virtually all equipment on any commercial airplane, including the various sensors, is reliable enough to meet the major failure requirement. That's a specific thing that they outline. They explain it in detail what a major failure is. It just means the probability of failure must be less than 1 in 100,000. That's what they define as a major failure. A major failure is not expected to produce any serious injuries, and it's defined more as something that would increase the cockpit crew's workload. Such systems are therefore typically allowed to rely on single input sensor. Boeing analyzed what would happen if, in normal flight mode, MCAS triggered inadvertently up to the maximum authority and moved the horizontal stabilizer maximum 0.6 degrees. It also calculated what would happen on a normal flight if somehow the system kept running for 3 seconds at its standard rate. So you notice they say 3 seconds there. Right here it says, why 3 seconds? That's the period of time that the FAA guidance says it should take a pilot to recognize what's happening and begin to counter it. That part, when I was reading through this article, so I mean, we were visiting family, my wife was driving, it's like a 2-hour drive, and I'm reading through this article and I get to this part where it says, why 3 seconds? That's the period of time the FAA guidance says it should take a pilot to recognize what's happening to begin or to counter it. What kind of person could be able to recognize what's going on within 3 seconds? You've seen the cockpit of these planes. They have 1 million dials. I don't get how they can realistically expect anybody to recognize that in 3 seconds. It says, according to the document reviewed by the Seattle Times, Boeing's safety analysis calculated this hazardous MCAS failure to be almost inconceivable, given the improbability of an airliner experiencing a wind upturn, compounded by the unlikelihood of MCAS failing while it happened. Boeing came up with a probability for this failure about once out of every 223 trillion hours of flight. In its first year in service, the MAX fleet logged 118,000 flight hours. So even though the original version of the MCAS required two-factor, angle of attack and G-force, to activate, Boeing's analysis indicated that just one sensor would be acceptable in all circumstances. So you can see how this happens. It just gradually deteriorates. As the story moves on, it started as something that was reasonable. It just slowly moves on to this worse situation. It says the flight test pilots had found another problem. The same lack of smooth stick force was also occurring in certain low-speed flight conditions. To cover that issue, engineers decided to expand the scope and power of the MCAS. So the MCAS was something they didn't want to use at all. They tried to create physical ways for the plane to fly. They used it in one very unique situation where it was paired up with also something that determined the G-force. And then they took that down, saying it was very unlikely. And then when also they had issues with the plane flying while flying at low speeds, they decided to use the MCAS for that as well. So you can see how this thing just metastasized into a bigger problem. Started off and they increased the scope of it to cover other conditions. Now, skipping forward a bit, it says a variety of employees have described internal pressure to advance the MAX to completion, as Boeing hurried to catch up with the hot-selling A320 from rival Airbus. Meanwhile, staff were expected to stay in line, Rabin said. It was all about loyalty, Rabin said. I had the managers tell me, don't rock the boat. You don't want to be upsetting to executives. That's something, these type of things where they're saying that there's internal pressure, they got to get the plane out, to compete with their competitors. I believe it, but I don't think that would just drive them to make totally unsafe choices deliberately, because Boeing has a pretty good record for safety and they've always been competitive. And so these type of things, I think they do happen. I think there's competition there that drives them to maybe not spend as much safety on it. But I don't know if this is the actual main factor that a lot of people try to pin it on. They say it's only competition. That's what caused everything. But I don't really agree with going that far with it. Now, this goes on for more. Boeing has said that to deal with this, pilots need to first have basic hand flying skills. Pull the nose up where you want it. Then use the thumb switches on the yoke that connect electrically to the stabilizer to neutralize the force. And then shut off the MCAS with the pilot checklist procedure on how to handle the runaway stabilizer. Do you like how Boeing lays it out? Like it's just this simple, go through this task list and everything's okay. This is really easy. This is just a task list of stuff we said. If you actually look at what happened in the planes, what was going on, it just paints such a different picture. It says, however, in both accident flights, the angle of attack sensor failure set off multiple alerts, causing distraction and confusion from the moment of takeoff, even before the MCAS kicked in. On the Ethiopian Airlines flight, for example, the stick shaker noisily vibrated the pilot's control column throughout the flight, warning the plane was in a danger of stall, which it wasn't. A computerized voice repeating aloud, "Don't sink," warned that the jet was close to the ground. A clacker making a very loud clicking sound signaled that the jet was going too fast, and multiple warning lights told the crew that the speed, altitude, and other readings on their instruments were unreliable. So they have like 8 different noises and a thing repeating "don't sink" to them while they're trying to go through this. Oh yeah, all you have to do is a basic hand flying skills, pull the nose up where you want it, use the thumb switch to the yoke. This dumb list of stuff they're supposed to go through, why they have 8 different alarms telling them different things. Again, an impossible situation for those pilots. I feel bad for families of them that they're kind of getting blamed, like the pilots were at fault for this, or they didn't do the checklist right, that type of thing. They didn't, but for obvious reasons. It had all this stuff going on during it. Now, later on at the bottom of this article, to close it out, it says, last Sunday at the Paris Air Show, Boeing CEO Dennis Muilenburg reiterated the company's position that while the original MCAS was properly designed, we know it can be improved. I just think that's such a ridiculous way to phrase it. He says the fixes include relying on 2 sensors rather than 1, limiting MCAS to 1 rather than multiple activations, and revising the software. So, yeah, I guess technically it went through their design protocols, but that just highlights that in some very specific situations, like the MCAS, the design protocols didn't do their job. They put pilots in a situation where it wasn't just extra workload, it was a nearly impossible situation that I think you put any good US pilot in there, they might be able to recover it if they have a tremendous amount of experience with it. But I could see them having the same outcome of confusion leading them to do the wrong steps. That hopefully gives you a little bit of background of how this type of thing happens. Now, you can look at this information, do with it what you will. Obviously, there's some things I don't like about how Boeing has handled this, trying to just put off blame, but that's really what you do in a case where there's liability at stake. They're trying to protect themselves from being sued, try to minimize the damage of this. My thoughts on Boeing have not changed that much. I said a while back that this stock is the type of stock that can't really have a hiccup happen to it. Now, I said that before the plane went down. Obviously, it has had a hiccup happen to it. But I think the point kind of stands when it has something this drastically bad happen to it. It only falls this much. If we go and we actually look at what analysts are saying to rate it at, if I go to MarketWatch here, it has this aggregation of different analyst ratings. The average is overweight. It's between, there's a lot of, most of them are saying it's a buy, and then some are saying are hold, and then some are saying are overweight. Notice that not any analysts say that it's underweight or sell. So not any of them have a negative outlook on Boeing. And as far as the dividend, because after all, I'm a dividend growth investor, that should be the thing I look at the most. If I actually go, and there's a website called Simply Safe Dividend. It's kind of this privately owned little website where they go through and they analyze dividend stocks for their dividend safety. And they assign them a score. And they're pretty accurate. They gave Boeing a 98, which is very safe. And they only do that if they're very confident that there's really not a chance that that company's going to be cutting its dividend. It does occasionally happen, but I think it's like an extremely low percentage do. So they believe Boeing is about as safe as it gets as far as their dividend safety, meaning it's not going to get cut, it's not going to get slashed, they're not going to be messing with the dividend. You combine that dividend safety with the analyst ratings, it gives you an idea of it. Now, analyst ratings, I don't really base my buying and selling off of them. You can take this for what it's worth, but the outlook is pretty positive on it. If we actually look at some of the numbers here, the current starting yield is 2.2% on Boeing. They have a 52% payout ratio, so they have enough money to keep paying this dividend. They've been growing it for 8 years consecutively at a very fast rate. If we go to the dividend growth here, look at some of these numbers. 20% last year. I mean, it's from 15 to 28%, their dividend growth rate. You can see on the graph here, it's pretty crazy. If I go to this dividend history graph, yeah, just the last 5 years, they've been increasing this dividend like crazy. So I don't know if they will continue to increase the dividend at this rate, but I couldn't see them cutting it. I'd be very surprised if they did that. But they might slow down the rate they're increasing it with the troubles that they've had. Regardless, I just wanted to give a quick update on this. Boeing is a company that the worst thing that I think really can happen to it happened, and I think it will weather through it. I really do. I think that they will come out with their planes. They'll be able to still get the orders. They've already been getting some surprise orders at that show. They got like 200 planes ordered that was unexpected. But this is a company I'm still positive on. My outlook on them still positive. It hasn't changed much. I plan on just continuing dollar averaging into them. Okay, let's move on from Boeing and talk about Bernie Sanders' proposal here.
That is why this proposal completely eliminates student debt in this country and ends the absurdity of sentencing an entire generation, the millennial generation, to a lifetime of debt for the crime of doing the right thing, and that is going out and getting a higher education.
So that's Senator Bernie Sanders speaking there. And I just want to say, before even going into this, I don't care what politician, what person that you attach this policy to. So this has nothing to do with Bernie. I'm not telling you who to vote for. I don't care about the political side of it. You could attach this to Trump. You could name your favorite politician and your least favorite. Attach it to either of them, and my criticism for this will be the exact same. So this has nothing to do with Bernie. His proposal is that a lot of students in my generation, in the millennial generation, I'm 29 years old, they came up and we grew up. I mean, I think everybody in my generation grew up to believe that college was the ticket to success. That's what your parents told you, is that you're going to be a pothead loser if you don't go to college, not accomplish anything, not be able to afford a house, have a good life. You'll be working dead-end jobs all the time. And if you go to college, you will be employed. You'll make lots of money. You'll have the American dream, be able to afford a house and all of that. That's what was like ingrained in your minds going into it. And then what happened is you go to college, you find out that colleges are really expensive, more than you can even fathom. You don't really have a good grasp of money. You have these banks and lenders telling you that you can take out as much loans as you want. And if your parents did not look out for you, did not warn you constantly of the dangers of debt, like my parents did, where my dad talked about debt like it was in line with the devil. I mean, it was constantly, the phrase, again, I hear it over and over again. The people that understand interest, they earn it, they don't pay it. People that pay interest, they don't understand it. It's just that type of attitude over and over again, all these different financial discussions. I never went into debt for college. I literally never took out a single loan for it. Went and worked different jobs to pay for it. Not good paying jobs, but just went part-time a lot of time and worked through it that way. But most people are in a situation where they did not do that. These people, the $1.6 trillion in debt, this is particularly people that went through, a lot of them went to expensive colleges. They were told that just go to the best one that you can. It doesn't matter if it's the best return on your investment or your time or your money. Just go to whatever one's best. So they take out huge amounts of loans. And I think there's this psychological factor when you're taking out these huge loans that you don't really know the impact of it. You don't feel the impact of the money you're being given. And so these aren't loans just for tuition either. These are loans that paid for tuition, paid for housing, paid for transportation. So a lot of people, it's not just like, oh, I got a loan for my one semester of college. It's like, I got a loan for me to live for 4 years. My whole life, everything that I bought and did was on a loan. And they have really high interest rates as well. They're loans that you can't default because they're federally backed loans. And then what happens is you find out that it was not a good idea. And you realize the compounding nature, the magical thing that makes investing like this, where I can see my money compounding and working for me, and I'm earning interest on top of my interest and dividends on top of my dividends. That same compounding works against you when you have student loans. If you have that 7%, 6% student loan, that's compounding against you. It's going to be doubling every 7 years if you don't pay it off. Now, I can see that perspective where that's difficult. I feel bad for the people that are in that situation where they really went into it and they went to college when they're 17, took out huge loans, didn't know what they're getting into, and now they're stuck with them. And Bernie, his proposals, pretty appealing to that. But the issue I have is, I mean, you heard in that clip, he talks about Wall Street. And, it's like we bailed out Wall Street. Well, now it's time for Wall Street to bail us out, right? It's kind of this rallying cry. It paints Wall Street with scare quotes as the bad guy there. Wall Street is you and I. This is a thing I don't understand about it. Congratulations, everybody that opened up an M1 account that's funding it and investing. You're Wall Street. Bernie Sanders is coming after you and your wallet to pay for this. You're the exact people he's targeting with this. The banks, the couple banks that made these huge derivative, incomprehensible type of financial products that went under during 2009 that actually caused the recession that had to be bailed out, that was one small segment of Wall Street that was a couple banks and bankers working there. What he's targeting is not a couple banks. What he's targeting is everybody that invests in the stock market. Average Joes that contribute to their 401ks. He's targeting them. And the way that he's doing it is by targeting trades. If you actually look at the fees here, it says Sanders is proposing to pay for the legislation with a new tax on financial transactions, including a 0.5% tax on stock transactions and a 0.1% tax on bonds. Do you have any idea how much of a tax that is? 0.5%? If I go over to my portfolio and I look at some of my actual ETFs, I mean, we were talking about SPHD. If I go and I search SPHD, every time that I've talked about SPHD, I've gave a warning. I said that this fund, although I like it, it has a pretty high expense ratio. The expense ratio of SPHD is 0.3. The tax that he's wanting to do is 0.5%, not yearly, on every single time you buy or sell a stock. So if you buy in and sell a few times throughout the year, you've paid like 4 or 5 years worth of that tax. And 0.5%, that adds on more to your cost basis on every single thing that you buy. You have to factor that in. It's especially bad for platforms like M1 Finance. If I go over to my activity here, every single one of these transactions, all these dividends, all this activity here, all of my deposits, every single one of them, I'd be paying that 0.5%. That would add up really quickly. It would completely destroy this type of strategy. If he somehow did get elected and then was able to vote this get this voted through Congress or whatever, I would have to change this portfolio. It would no longer be viable. It'd be adding a 0.5% tax onto all these different holdings. The only strategies that would really be feasible is having a couple ETFs and doing as the minimal amount of transaction as possible. When you have individual holdings like this, there's more selling that goes on because it's not just in a fund, you're buying and selling more. That would make it so that you're just paying that tax over and over again a lot more frequently. So that's the first thing I don't like about this is he's painting it as though he's targeting Wall Street, these banks, when in reality, he's targeting just your average Joe investor. And I don't think that that's fair. Another thing that I don't like is the whole idea of part of his platform with socialism in general is to have, they always talk about socialism, democratic socialism, is for people to have the means of production, right? This is where your average people have the means of production, mean that they're stake owners in companies, they're control owners in companies. The way for average people to do that is by buying into the stock market. That's what transitions you in life from being an employee, just being a little slave wager, going and working your job day in and day out, to being an owner, to being a participant in the profits of a company. You make that transition by buying equity in companies through brokers like M1 Finance. What he's doing is disincentivizing a very good behavior. Buying stock is a behavior we should be incentivizing. M1 Finance is doing a good thing by making it free, making it more democratized so more people can do it. What Bernie Sanders is suggesting is to do the total opposite, to disincentivize it, to make it so it's not free. And not only is it not free, but I want to tax every transaction you do to make it so that you do less transactions. to make it one more hurdle for the small person to be able to enter the stock market and get that part of their life going. So I don't think the incentives are in line there. Beyond that, I see just a bunch of fundamental problems with this. Let's consider this for a minute. At least Elizabeth Warren, in her plan, she said that this wouldn't apply to the people that earn like $100,000 or more. Let me go ahead and read this quote. And this is from the Washington Post. So this isn't like a conservative website by any means. The quote says, "The cost will march towards $3 trillion and benefit a lot of wealthy families and future high earners," said Ryan Riedel, an analyst at the Manhattan Institute, libertarian-leaning think tank. "Of all the problems requiring a $3 trillion federal expenditure, the college costs of middle and upper class college graduates seems lower priority." So Brian Riedel, this analyst, I agree with him 100%. He highlights a good point here. Bernie Sanders in this proposal does not make any distinguishment between what school you went to, what degree you have, or your earning potential. So a lot of people that are in the most amount of debt, that's factored in. They're going to be getting the highest return on their investment. So this is people that went to Princeton, that went to Stanford, that went to Yale and Harvard, people that are going to become lawyers and doctors and high-end engineers, and people that are going to be very successful. Now, they've taken out debt. They got accepted to really good schools. And in the meantime, before they get their earnings up and before they lead a very successful life, they're going to have their debt wiped away by average people that did not get the benefits of their education. So I can give you a real life example of this. My oldest brother, I've talked about him before, he's a surgeon. He's not just your average surgeon. He's like a really specialized eye surgeon. So when you go to college and graduate with a master's, and then you go to 4 years of medical school, and then you go to 2 years of specialized, or you go to 2 years of surgeon training after that, and then another 3 years of specialization, obviously you rack up an enormous amount of debt during that time, right? Now, under Bernie's plan, people like that would have a lot of debt, and they would make up a good portion of this $1.6 trillion. They say about like 2/3 of them are going to be high income people. These are people that went to college that are going to get a return on their investment because we know college is not a terrible investment in most cases. So going back to my brother, instances like him, do we really need his debt being paid off by people that are struggling, making $40,000, $50,000 a year and barely putting in $200 a month into different brokers, buying their little Robinhood accounts, little M1 Finance accounts? Do they need to fund people that went to 10 years of medical school? You can look it up. What does a retinal specialist eye surgeon make? Like the average starting salary is around $400,000 a year. These are people that do not need help getting their debts paid off. So this plan has a lot of fundamental problems. One of them is its wealth transfer from low-income people that either didn't go to college or went to very inexpensive colleges, scraped by, tried to keep their debt low. It's wealth transfers from those groups to people that went to Ivy League schools that are going to be high income earners. That's one problem with it. Another problem, like I pointed out, is that it disincentivizes a good behavior. Good behavior is investing in the stock market. That's what makes you become equity owners. That's what makes you become people that share in the ownership and the benefits of companies. That's another thing this does. It disincentivizes that. Another thing it does is there's just a general level of extreme unfairness. If you listen to the Dave Ramsey show, think about how many of those debt screams you hear. People that, I'm debt free, and they're so excited because for the last 5 years, they've had blood, sweat, and tears paying off their student loans, and they finally got them behind them. And then now they're going to be told, well, good job paying off your student loans. You didn't need to. And now you're going to have to pay off other people's student loans that weren't as responsible as you. So, and now that you're at a point of life where you don't have student loans and you're going to be able to invest, now you're paying off other people's student loans because they chose to just pay the minimum payments or defer theirs or go default on theirs. They didn't want to pay them off. So you're going to be paying off theirs. I'm not even in that situation, but I still would feel incredibly, I just have a third-hand feeling of unfairness for people in that situation. And then probably the people that are just the worst for them are the people that just never went to college. These are the people that we know make the least amount. Now, if they have any chance of doing anything successful, which a lot of people that didn't go to college, they did it because of better opportunities, right? So a lot of people are going to turn out just fine that didn't go to college. but they're going to be paying for people that did and get the benefit for it. They're paying off of their debts, people that didn't benefit from college at all and likely make less on average. So lots of issues with it. I see the argument for it, people saying that it cycles more money into the economy and stuff like that. But those same arguments could apply to everything. Forgetting people's credit cards, just wiping away people's credit card debt. That would cycle more money into the economy. It would allow more people to buy homes. All the same arguments apply. I don't see any distinction between this debt of student loans and just credit cards, with most of the arguments people make to say that it's a good thing. So that's my thoughts on it. I want to reiterate again, you could attach this policy to anybody. I really don't care who it is. It happens to be Bernie Sanders. I would say the same thing if it was Trump. It's hard to give another example. He's the only one on the conservative side, I think, or Republican side running for president. But this has nothing to do with the candidates. This is something that directly affects the stock market. I think it's relevant financial news. So that's my feelings on this policy. I'd be interested to know your guys' thoughts as well. If you think I'm wrong on anything, what your thoughts are. Okay, so that's enough of that. I did have about 6 or 7 questions I wanted to get to, but we went a little long in this video, so I'm going to have to answer those in the next one. I'll be doing another one this weekend. If you do have a question that you want answered, just email josephcarlsonshow@gmail.com. So that's josephcarlsonshow@gmail.com. And if I think it's interesting or relevant to the rest of the audience, I'll answer it on one of the episodes. So I try to get to all of those. And if I don't answer it in the episode, I email you back. But either way, you can email me there. This weekend, I'll also give you an update, see how this week goes with this portfolio. If you do want to invest in this portfolio, this is a dividend growth portfolio I've made. The whole series, the dividend growth series, tracks that. So you can look at my earliest videos to see episode 1, where this thing was, I think it was like 25,000 when I first started it, the YouTube series part of it. But if you do want to invest in it, there's a link in the description that will allow you to invest in my exact pie. So you can start with this exact portfolio and then edit and tailor it how you want. So that's in the link of every description of the video, as well as every podcast description. You can find that. So that allows you to invest in it. But yeah, and just a reminder, I'm on, I think, all the podcasts, pretty much all of them. So you can find the show there as well. Anyway, hope you guys have a good week. I'll catch you this weekend.